Greetings. My name is Eszylfie Taylor, Taylor Method question and answer series. I really like these times because I get to answer your specific questions and dive right in. I do have several questions that have been posed to me over the last few weeks that I will get to. And if anyone has any questions or any thoughts or anything that I can help out with, through the course of this call, maybe that you have not submitted previously, feel free to enter those into the dialog box, and time permitting, I will address them. So first question that we have comes in from a gentleman. How do you explain that the cash value crediting is not exactly equal to the dividend? So first you have to understand how these policies work, right? So let's talk about permanent insurance because term obviously doesn't have any cash value component. A whole life policy, one in particular that's issued by a mutual company, allows the policyholder to share in profitability from the company. So by definition, dividends are return of excess premiums or revenue, right? So generally speaking, there's something called a dividend interest rate that's associated with a whole life policy. If you look at any of the big carriers from the Mass Mutuals to New York Life, Guardian, Northwestern, Penn Mutual, they all have this declared dividend interest rate. There's actually a one sheet. I don't know if we can share it with you, but you could probably find it if you Google it. Google dividend interest rate of top mutual companies, whole life companies, and I'm sure it will pop up. But to your point, the dividend interest rate is not directly correlated to the increase in year by year cash value, in large part because there's cost of insurance, fees, and expenses. So it's not like a savings account. So for example, if you go, hey, if the dividend interest rate is 4% and I put in 100 grand a premium, why in year one then does my cash value not go from 100,000 to 104,000, right? If the dividend interest rate is 4%. Again, because there's fees, commissions, cost of insurance, and all these expenses. The best way that I can explain the accumulation of a permanent policy would equate it to like a mortgage. If you look at a 30-year fixed mortgage, there's something called an amortization table. The amortization table shows you the schedule of payments, shows you what percentage of your payment is principal, what percentage of your payment is interest. And if you look at an amortization table, at the forefront of that mortgage, what's most of the payment? It's interest. So if I was making $30,000 a year of mortgage payments year one, right? I got the mortgage year one, I make 30,000. Some people might think, yeah, I have 30,000 of equity. No, you don't. You might have $5,000, $6,000 of equity because most of that payment, 25,000 of that 30,000 was interest, right? Year two, I'm paying less interest, more principal, and so forth. And this is evident because naturally you would think if I have a 30-year fixed mortgage, at year 15, I should be about halfway paying off the mortgage. No, if you look at an amortization table, it's usually like you're 21, 22, that you're about halfway paying through the mortgage. And then what happens in those last years? In those last years, as you're making payments, you're really just banging down that principal balance. Same thing is true in a life insurance contract. If you look at the IRR on cash in the beginning years, it's negative. I pay $10,000 of premium, I could pull out like two, right? That's negative 80%, right? And then I pay another 10,000 year two, and I'm at 6,000. I'm still down, right? And so forth. Depending on the carrier, geez, in this interest rate environment, it might take 10, 11, 12 years to hit break even, meaning premiums paid to available cash value. That's the point at which, right, the spigot reverses. And now you're looking at tremendous cash value increases year by year for premiums paid. So to ascertain the IRR, the internal rate of return, which is really the number that you want to look at for life insurance, not the dividend interest rate, generally speaking, it's going to take 10 plus years to get to positive. And over the course of 20 years plus, that's where you're going to see that 4% plus 5% IRR, that 5% internal rate of return. You know, does that make sense? So you can't look at the dividend interest rate and equate that to cash value. It has to be the internal rate of return, right? So it's pedestrian, more than pedestrian. It's a loss in the beginning years. And then as the policy gets older and older and older and older, that's where that cash value really starts to bolster, you know, on the back end. You know, one crude analogy that I'll give clients is I'll tell them, look, I am a genie. I am the all-knowing Negro Damus. I have it all in my head. I can tell the future, okay? And you're going to invest with me, and I'm going to tell you what's going to happen, exactly what's going to happen, okay? Year one, you're going to give me money. You're going to lose money. I'm sorry. Year two, you're going to give me money again, and you're going to lose money again. Again, I'm sorry, but from year 3 on, for the rest of your life, every single time you give me money, your cash value, you will make more money than you did the year before for the rest of your life. Would you invest with me? So for the first year, I lose money. Second year, I lose money. But from the third year on, for the rest of my life, every time I give you money, I make more than I did the year before. Yeah, I would invest with you. It's kind of how whole life works. The reason that it takes so long to get to that break-even point is for that big lag in the beginning years, right? But once that policy starts to get steam, right, get rolling, I'll put a 10-year-old, even plain old vanilla whole life policy against most any financial instrument out there, right? Just in terms of growth, right? So it's all a matter of perspective. But I see one of the biggest things and biggest failures that we make as advisors in selling permanent insurance is we have to actually highlight the fact that it sucks in the beginning. We have to highlight that and tell them, look, if you're looking to do this for a year or two, don't do it, save your money. But if you're in this for the long term, 10 years, 20 years plus, man, you'll wonder why you didn't put in more. 20 years from now, there's no reason when you see your cash value doubling and tripling over time, they're going to go, I hate this thing. What you're going to say to me is, I wish I had more. So I just need to help you find that delicate balance between what do you need today? What do you feel comfortable paying today? Keeping in mind that there's not going to be a lot of liquidity in the beginning years, right? But then in the back end, right, you're going to love it, right? That's how I explain that. All right. Next question. If a client says that they want their kids to inherit their investment property, and we inform them of the estate taxes and show them a whole life policy will offset the tax and the decline due to cost of premiums, how do you overcome that? A couple things. Number one, it's not about cost, it's about value. For example, if my client's estate was worth 20 million, and there's, just for round numbers, say an $11 million estate tax exemption. So that leaves $9 million, right? That's subject to tax at the current rate of 40%. So they're going to lose roughly $4 million in tax, right? That is what their heirs are going to cost. It's going to cost their heirs, right? If I were to propose a life insurance solution that could be very expensive, right, relative to things, but that life insurance was going to cost $1 million of premium, not a little bit, $1 million in premium, but provided $4 million to their heirs tax-free to pay off estate taxes. Does that not make sense? So here's my simple question. Let me ask you a question, Mr. Client, right? Would you rather pay the tax dollar for dollar, or would you rather pay the tax of 25 cents on the dollar? All right. Now here comes opportunities for advanced planning methods, and this is actually maybe a good segue. I believe on June 1st, I'll be launching a series of 4-week boot camps. I have an intermediate series and an advanced series, and what I'm going to be talking about here is plans like this in my advanced series. So a couple things. If I'm buying life insurance for estate planning purposes, not accumulation, I typically am going to stay away from whole life, right? Because whole life insurance